Welcome everybody to the Ellsworth Advisors monthly update. I'm Kuennen, Cameron Miele with Ellsworth Advisors, and today we're going to basically talk about year-end 2019 through December. We'll have year-end numbers, also talk about the monthly numbers for December, quick update on the economy, a little bit of what happened last year, kind of where we're at now, some of our expectations moving forward, and discussion on how our portfolios performed and so forth. So what we'd like to do is start off with Cameron, kind of a economic update, and we'll jump into the portfolios after that.
Sure. Thank you, Kelly, and Happy New Year to everybody. Kelly, what I really want to talk about today is everybody's, the hot button issue right now is what's going to happen in 2020. Obviously, we're not prognosticators. We don't claim to be. The reason we manage money the way we manage money is to try to provide stability and conservative growth in both up and down markets. But the question is, you see economists discussing it every day in the news is, what are their forecasts? Is there going to be 2% growth in the U.S. or 3% growth? Are we going to see a recession? And I want to touch on a couple of points because I think what's very interesting is if you look at, again, historical bull market, everybody's expecting there to be a recession. But if you look at over the month of December, the news that we got and some of the numbers that we got, it really still suggests that there could be some tailwind to not only the U.S. economy, but the global economy. So just in December alone, we had the United States, Mexico, and Canada agreement finally be ratified in the House of Representatives after almost a year. This is a replacement of NAFTA, the former North American Free Trade Agreement. It was passed overwhelmingly in the House and expected to pass easily in the Senate, maybe even this week. I want to give you one key line from the act. It's focused largely on auto exports, steel and aluminum tariffs, and dairy, egg, and poultry markets. One provision prevents any party from passing laws that restrict the cross-border flow of data. Compared to NAFTA, USMCA increases environmental and labor regulations and incentivizes more domestic production of cars and trucks. The agreement also provides updated intellectual property protection, gives the United States more access to Canada's dairy market, imposes a quota for Canadian and Mexican automotive production, and increases the duty-free limit for Canadians who buy U.S. goods online from $20 to $150. So more auto sales in the U.S., auto production in the U.S., better access to the dairy and poultry markets in both Mexico and Canada, and an increase on the duty-free limit for Canadians who buy U.S. goods. It's all good for America.
Yeah, one estimate I heard was 0.3% GDP bump.
GDP growth, yes.
Based on it, so that's a good thing.
That's great for our country, and give it again to this president. He saw the former North American Free Trade Agreement. He saw that it was incredibly favorable to both Mexico and Canada, and he stepped in and said, we're going to do something about it. We also have President Trump is expected to sign phase one of the renegotiated trade deal with China on January 15th. Again, a lot of people said, we're going into a trade war with China. This is going to disrupt global trade. It's a terrible thing for the U.S. Again, the president saw that there was a problem with our relationship with China. He stepped in. So far, it looks like what he's doing is working, meaning we've got phase one. It's the smaller phase. It's the easier phase. It's the goods and services that are the lowest in question, lowest in value, lowest controversial. So it's a great first step. We also, in December, was the president impeached in the House of Representatives? Yes. Is the threat of a sitting U.S. president being removed from office now look likely? No. That would create a lot of instability. Fourth quarter U.S. retail sales are expected to show continued consumer strength. The rest of the world continues to show signs of accelerated growth. And 2 weeks ago, China announced a $100 billion stimulus package. So you put that all together, we get two better trade programs for the U.S. We remove the threat of a sitting president being impeached. We see good consumer data. We see China putting in a $100 billion stimulus to their economy. We see the rest of the world starting to accelerate in growth. And, it all has the markings of what could be a very strong 2020. Now, there are certainly issues out there, Middle East conflict, credit bubble, there's all sorts of things that could happen. But right now, I still see more tailwinds than I do see headwinds.
Yeah, I agree for the most part.
To the most part.
I think we have a lot of good stuff happening right now. One of the expectations in December was that manufacturing was firming up. There's definitely been signs of the rest of the world starting to see some acceleration. The early ISM numbers still came in a little bit weak for December. So the thought process there is, yeah, they've still been a little weak, but the expectation is that we're going to see improvement there. Maybe it starts to come this month. Obviously, I think a lot of the trade stuff kind of put a little bit of a damper on things this last quarter. Things got a little hot and heavy, but ultimately we're going to be able to work through it. We have some kind of agreement coming up here in a couple of weeks. That's good. There's going to continue to be tensions between China. That's kind of an evolving landscape.
It's going to be headline noise.
Just like what we see in the Middle East, we have issues going on there. It's getting a little bit more heightened right now in the news, in the media. We saw that affect the market the last couple of trading really on Friday. But the reality is when has there been certainty in the Middle East or stability in the Middle East?
I don't believe in the last 1,000 years, Kelly.
Yeah, so that's nothing new. It's just when it pops to the headlines. I think, our trade tensions with China, there's always going to be tension there. It's kind of been brought to the forefront where, there are disagreements in the way the U.S. manages their economy, the way China manages their economy on the philosophical level. So these are all issues that aren't going to cause the end of the world, but these are issues that individual companies need to address when they're doing business in China, not just at the national level, but you take it down to the individual company level. And individual companies, when they do business over there, they know the risk they're taking. Yep. Hey, we're going to set up a plant in China. Well, you're not putting all your eggs in that basket. If you are, you're a fool. And those are companies we would not invest in because of the risk there, or at least we have to assess the risk. Is it worth taking on that risk when the rules could change at any point in time? So, we're always in uncertainty. Last year, that was always the hotbed. Oh, the uncertainty, and it's going to roil the markets. Well, you think back, when has there been certainty? I don't know of any certainty in my lifetime in the investing markets, there is never certainty. It's just how do we navigate it? And for the most part in our portfolios, we're not playing the macro view. Mm-hmm. We're not playing the big themes, but rather it comes down to we're buying individual companies.
Find those individual great companies.
And individual companies, if they're well run, they can navigate the landscape, and that's really that's really been the methodology we've been pursuing the last couple of years with a more quality oriented investments on the stock side, sticking with our highest quality bonds on the bond side, getting some commodity exposure to battle against some of the macroeconomic issues are out there. But for the most part, at this point, we're not really going to change that. GDP probably going to be pretty soft this quarter, but the expectation is acceleration going into next year. We didn't go in. Nobody's assuming that we went negative in GDP, no. And I think Cam mentioned that the expectations of a recession in the next 12 months are pretty slim. But the big expectation is, you're going to have a lot of headline noise. Obviously, the election coming up, that's going to cause that media headline noise as we get into the middle of the year in the spring and middle of the year with the election happening. The Middle East stuff, that cropped up, and that'll be probably the hot ticket for a little while until we get into earnings in a couple of weeks. And earnings are really going to tell the truth. What's happened with company earnings? What are the growth levels looking like? Expectations were set pretty low, so we probably have a fairly decent earnings period. Jumping to the markets for the year, the S&P 500 up 31.49%. Now these numbers are all coming from Macro Bond Financial. So S&P up 31.49 for the year. Great year for the S&P. For the month, about 3.89% for the month. So it was a good month in December. We really ended the year strong, unlike last year where we gave up 8-9% the last couple of weeks of the year. So a little different tone this year. The Dow Jones up 25.34%. So about 6% spread between the S&P and the Dow this year. International markets. So the Dow was up 2.34% for the month. The international developed world up 22.66%, and that's the EAFE. So international lagged, but still had a pretty good year. Last month, about 3.86% was the growth there. Emerging markets, kind of the laggard, 18.88%. In a trade tension type world, it's not surprising the emerging markets lag a little bit, but they still had a good year. Some of the expectations is that the emerging markets would be challenged with their debt, because of a stronger dollar, but that really has not come to fruition. The emerging markets have definitely evolved and have held up pretty well through a volatile year. So for the year, I mean, actually the month, emerging markets up almost 8% for the month. So that was a pretty solid run for emerging markets. Looking at our portfolios, the growth with income portfolio, basically our balanced portfolio for the year, and this is just a sample of client accounts that are kind of peer to the portfolio. Growth with income, I'm getting around between 18 and 19% for the year. So pretty solid year for growth with income. Last month, we were up about 3.5%, so pretty good month for growth with income. Some of the big drivers in there, Apple has been a holding in that portfolio. Apple up 88.97% for the year. Pretty that'll help drive returns. Nvidia, which we picked up late last year, late in 18. Well, actually, after the pullback at the end of last year, up about 56.97%, so only 57% out of NVIDIA. Microchip up 48% for the year. Nike up over 38% for the year. So those are nice stock gainers for us. Commodities made about 8% for us. I think we made about 16% in gold. So, in general, pretty good exposure there. If anything, our bond exposure in treasuries, we only made a couple percent there, but we needed that for ballast, and that helped smooth things out when things got rough in the middle of the year last year. Big losers in the portfolio, we had a position in Qualcomm, which we got out of early in the year. We had lost about 11% in there. Exxon down 1.91% early in the year when I bought that. I anticipated a little more strength in the energy sector. That 1.91% was erased last week with a little bit bump in oil. So, not a lot of big losers in the portfolio. Just last month, Microchip picked up 10%. Apple picked up 10%. Nvidia 9%. So, it was a good end of the year. Disney had a good year, down about up about 38%, but we lost about 4% last month, so still a good year there. CVS, really our only other loser in the portfolio for the month, down 1% for the month. Price potential, which is our stock growth portfolio, up between 27 28% for the year, so pretty solid. Outpaced the Dow, didn't quite keep up with the S&P 500. A lot of that's driven because of the tech kind of had a good push this last month, and we don't have a ton of tech exposure in price potential. Our big gainers for the year, Target up almost 55% for the year. Motorola up 42% for the year. Lithium Motors up almost 41% for the year. So those are just our three big ones. We had a lot of stocks that had nice gains in there throughout the year. Big loser of the year, QSR, which is quality restaurants. Burger King down 17. Showed some early signs when we bought it. I don't know how much longer that'll stick around the portfolio. Travelers down about 10%. So those are really our two biggest losers for the year. Last month, Estee Lauder had a good month, 5.6%. Becton Dickinson up about 5.5%. So not huge gainers in price potential last month. I think that's why we lost a little bit of ground to the S&P. Big losers last month, Miller Herman down about 12, and actually Motorola, even though it was a big gainer for the year, gave up about 3% at the end of the year this year in December. Dividend yield up between 23-24% for the year. About 1 3/4 for the month. This is our conservative dividend yielding stock portfolio.
What's the average yield that you're driving in that portfolio today?
Pure yield is about 3.4, 3.5. Okay. So
you get 22% to the upside plus a 3% yield.
Well, that 3% is part of the 22.
Oh, part of the 22. Yes. You're right.
Yeah, so it's part of the 22. But yeah, I mean, it spits off over 3% in cash, which is better than you can get in a 10-year or a 30-year treasury right now.
Call it 19% upside with 3% yield.
Exactly.
Pretty darn good.
That's always part of it. Big gainers in there. Southern Company, utility up 51% for the year. AT&T up 45% for the year. Our big winner was Blackstone, up 96.29%. We've held Blackstone for a couple of years now. The big thing that happened with Blackstone, prior to July, they were structured as a limited partnership. So clients Haven't always been happy about this position. We've always made a little bit of money in there, but we always had to deal with our K1s from it.
Yeah.
K1s, this is the last year of K1s, and when they switched to a corporation, the stock jumped immensely because now it can be included in indexes, eliminates the K1s. So, at this point,
yeah, I mean,
BlackRock, we can't complain about it. It's been doing well.
I mean, it completely opens up the investor universe.
The conversion was fantastic. Our only loser for the year was Pfizer last year, down 6.92%. So, our big loser, I think it was the only loser, was down 6.92 because that was the only one I could come up with. For the month, British American Tobacco up 8% last month, Merck up 5%. Boeing gave up some ground. In Boeing, we still finished the year positive in Boeing for everything that's gone on with Boeing, but it did give up about 11% last month. It's improved the last several days of trading. UPS has been a laggard. We picked them up, or just last month, we were down 2%. That's just a 1 month situation. Small cap portfolio, pretty much the laggard portfolios here up 17.67%. Small caps being smaller in nature, kind of all over the board. There were times when it was outperforming, underperforming. Last month we gave up about 1% in our small cap portfolio. For the year though, I mean, we always have our big numbers in here. NovaCure up 151%. Hamilton Lane up 64%, BioLife up 58%. So some big runners in there, but on the downside, renewable energy down 39%, SecureWorks down 45%. So we give and take inside that portfolio. It's always gonna be volatile, but still almost 18% is pretty solid year. For the month in December, Alamo was up, that's the car rental place, 9.36%, Exponent up 8.85%. But Tandem Diabetes, which had been doing strong for us, gave up about 13%, and Appian down 11%. So in general, portfolios performed as they should have. When things got a little stressful through the volatility we saw throughout the year, I think we held up really well. Outlook-wise, we're not planning for disaster, but I think we're going to continue with our quality slant and how we want to invest. The big thing is getting down to that individual client level, is making sure we have ample liquidity, ample dollars that are in safer areas, so that if we do have any shocks to the market on the stock side of the equation, that we're comfortable with being able to ride through those ups and downs by having liquidity on the fixed income side for clients that are taking income or have big expenditures coming up there where we're thinking about withdrawals.
And I think Kelly, really that's the important thing that I hope our clients do recognize, is that we really are looking at tailored solutions for each client and not looking at being wealth management financial advisor for the masses. Not putting together mutual fund portfolios, and the same portfolio that's right for customer A is right for customer B. It's really looking at each client's situation and saying, got kids going to college, we've got to have ample liquidity in case the market's down. We don't want to be selling into a losing market, or we've got a wedding coming up, or retirement's 3 years down the road. So, for someone like me who doesn't have those big expenditures coming up, we're being much more aggressive. For someone like my parents who are retired, we're being much more conservative. And we're looking at it on an individual basis, and it's all based on our feedback and our discussions with our clients, which is why that client interaction is so important.
Yeah, so we're in a good place. I don't see all green gas and goalposts ahead of us. Yeah. The market, pricing wise, the market in general, I think, is a little rich. That's why we're not index investors at this point in time, because I'd rather know what I own versus just owning the market. It's really a market of stocks, so we own stocks. But like I said, I don't see the big one coming. There haven't been major cracks in the system up to this point, but we also know where those potential cracks can start appearing, and we're trying to insulate against it. Look at what are our worst case scenarios, at least at this point, and that'll continue to change as the months go on. So that's where we're at. Happy New Year, everyone. If you have any questions or want to discuss your accounts more in detail, please reach out to us, and I'll look forward to talking to you as the year transpires.